One of the most underrated yet game-changing habits in trading is learning to see the market through multiple lenses. When you're focused on a single time frame, say, just the 15-minute or the daily chart, you're like a sailor navigating rough seas with only a flashlight. You might see what's immediately in front of you, but you miss the massive wave building in the distance. That's why today's episode, tip number 20, use multiple timeframes, is all about broadening your vision, learning to zoom in and out so you can truly understand the rhythm of the market. Let's start with a bit of perspective. Every chart tells a story, but the story changes depending on the timeframe you're reading it from. The weekly chart might show a calm, steady uptrend, smooth and convincing. But drop down to the 15-minute chart, and suddenly, that same market looks like chaos, swings, reversals, and spikes everywhere. The magic of multiple timeframe analysis is learning how to interpret these layers together. It's like reading a novel. The weekly chart gives you the overarching plot, the daily chart gives you the chapters, and the lower timeframes show the action scene by scene. In my own trading journey, I learned this the hard way. Early on, I would base my trades purely on short-term signals. I'd see a clean breakout on a 1-hour chart, jump in with full conviction, and boom. A few hours later, I'd be staring at a reversal I didn't see coming, all because I ignored the weekly resistance level sitting quietly above my entry. If I had simply zoomed out, that loss could have been avoided. You can't navigate the market effectively when you're flying blind on one timescale. You have to align your trades with the bigger picture, and that's where the concept of the top-down approach comes in. It's a structured way of looking at the market, starting from the higher timeframe, then working your way down. You begin with the weekly or monthly chart to define the trend. Are we in a long-term uptrend or downtrend? What are the key support and resistance levels that define the playing field? Once you've mapped that out, you move to the daily chart. Here, you look for confirmation of that broader trend, maybe refining your zones and identifying areas of consolidation or correction. Then finally, you go down to your execution chart, say, the 1-hour or 15-minute timeframe, where you identify precise entry and exit points that align with that bigger narrative. It's systematic, it's logical, and it dramatically improves your consistency. There's a quote by Bruce Kovner, one of the great macro traders, that really captures this mindset. The market is an extremely efficient mechanism for transferring money from the impatient to the patient. When you use multiple timeframes, you cultivate that patience. You stop reacting to noise and start responding to structure. Let's make this concrete with a case study. I want to introduce you to John, a trader who, like many of us, used to rely on gut feeling and a single chart. John trades the euro to US dollar pair, and after a string of inconsistent results, he decided to shift his approach. He began using 3 timeframes, the weekly, the daily, and the 1-hour chart. He starts on the weekly chart. And what does he see? A long-term uptrend, clean, steady, with higher highs and higher lows. That's his macro direction. He identifies support at 1.18 and resistance at 1.23, the range where most of the action happens. Now, John knows the big picture. The market favors buyers, but price is nearing resistance. Then, he drops to the daily chart, looking for refinement. He notices that within this broader uptrend, there's a sideways consolidation happening between 1.2 and 1.22, a pause before the next move. He adjusts his key levels slightly. Support now sits at 1.195, resistance around 1.225, based on the recent candles. The market is catching its breath, but still leaning bullish. Finally, he zooms into the 1-hour chart, and here's where things get interesting. He spots a bullish flag pattern forming, a continuation setup that aligns perfectly with the higher timeframe narrative. Price is hugging the lower boundary of that flag, suggesting that momentum might soon shift back upward. So John plans his trade. He places a buy order at 1.205, stop loss at 1.195, just below that daily support, and a take profit near 1.225, right under resistance. The trade triggers, plays out beautifully, and hits the target within the week. What's the takeaway? John wasn't guessing. He wasn't chasing candles. He was executing a structured, top-down plan. The weekly chart told him where the wind was blowing. The daily chart told him when the sail was catching it. The 1-hour chart told him exactly when to jump aboard. This approach doesn't just improve your precision, it changes your psychology as a trader. You start to trade with confidence because you're no longer reacting to every tick of the market. You understand why a setup works and where it fits in the bigger structure. And that confidence is priceless when the market gets noisy. Let's flip it for a second. What about traders who use the bottom-up approach? Some short-term traders start from lower timeframes and work upward, using higher charts only for confirmation. This can work, especially for scalpers or intraday traders who thrive on quick setups. But it's riskier because it can tempt you to trade against the broader trend. The key, whichever direction you analyze from, is alignment. When your lower timeframe entry aligns with your higher timeframe trend, your probability of success increases dramatically. And speaking of risk, multiple timeframe analysis naturally improves your risk management. When you're aware of key levels on higher charts, you're less likely to place your stop-loss in dangerous areas where price is likely to whipsaw. You're trading with structure, not emotion. You're no longer surprised when a perfect breakout suddenly reverses, because you already saw that it was heading straight into resistance on the daily chart. This awareness is what separates the amateurs from the professionals. As Alexander Elder once said, the goal of a successful trader is to make the best trades. Money is secondary. Using multiple timeframes is about making the best trades, structured, thought out, high-probability decisions rooted in data and context. You're stacking the odds in your favor, not relying on luck. Here's my challenge for you this week. Pick one of your favorite trading pairs or assets, maybe Euro to US dollar, maybe NASDAQ, maybe even Bitcoin, and study it across 3 timeframes. Start from the top. Map out the long-term trend. Then zoom in and see how the smaller movements fit within that structure. Ask yourself, are my recent trades aligned with the broader trend? You might be surprised by what you find. I want to hear from you. How do you use multiple timeframes in your own trading? Do you prefer the top-down or bottom-up approach? Leave a comment and share your experience. Your insight might just help another trader refine their perspective. Remember, trading is all about clarity, not speed. When you learn to zoom out before you zoom in, you stop chasing trades and start executing with purpose. And that's where consistent profitability begins.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.